Good afternoon, and thank you for joining us. I'm James Wolfe, Assistant Vice President at the Travelers Institute, filling in for Joan Woodward, and I'm thrilled to be here with you today. Welcome to Wednesdays with Woodward, a webinar series where we convene leading experts for conversations about some of today's biggest challenges. Before we get started, let's briefly review our disclaimer for today's webinar. All right, and I want to give a huge thanks to our co-hosting organizations, the National Association of Professional Insurance Agents, the Connecticut Business and Industry Association, the Masters in FinTech program at the University of Connecticut School of Business, the Insurance Association of Connecticut, the Metro Hartford Alliance, and of course, TrustedChoice.com. All right, so for the next hour, we're going to take a deep dive into the latest trends in the US economy and the impacts that interest rate cuts, consumer spending, and GDP growth will have on your business. We're also going to explore the impacts of critical legislation like the CHIPS Act, the Inflation Reduction Act, and the Bipartisan Infrastructure Law, and get in-depth insights into the auto, real estate, and construction sectors to help you navigate the economic landscape. And I'm thrilled today to welcome our special guest, Curtis Dubay, who's going to offer his insights and expertise for this conversation. Curtis is the Chief Economist at the U.S. Chamber of Commerce. Prior to joining the U.S. Chamber, he was senior economist at the American Bankers Association, where he worked on tax issues and followed the economic trends affecting the banking industry. His insights are published frequently on a wide range of economic and tax issues, and he's frequently quoted in the media and has testified before Congress several times. He'll kick us off with an opening presentation, and then I will rejoin to keep the conversation rolling and take your questions. So Curtis, the floor is yours. Thanks for joining us.
Thanks, James, and thanks for having me. It's a pleasure to be here. If you can't tell because the resolution isn't enough, I have my Yukon Huskies tie on. I have my Yukon Huskies cufflinks on. I actually have Yukon Huskies socks on as well. I'm a native of Connecticut. I grew up in Ellington. And as a matter of fact, I worked as a summer temp for Travelers in the Tower in the summer of 2000, and there's my ID card to prove it.
Wow.
It says on the back, summer student with my signature. That's me at 19 years old. And my mom dug this out of my sock drawer, which is still in my bedroom in Ellington. So it's a real thrill to be here to talk to you today about the economy. It's a tricky economy to talk about. And the reason why is that no one wants to accept the fact that the economy is in pretty darn good shape. There's a lot of reasons for that, and we'll get into that as we go forward. But it's taken me a long time. It's taken a lot of us a long time just to accept the fact that the economy is doing really well. And it has been for several years. Now, of course, there are things like inflation and higher interest rates that are causing people to feel the economy isn't doing so well. But at this point, we really have to just acknowledge that the economy is going very strongly. And probably most importantly, is that it will continue to do so until something happens. Economies don't shift down, they don't decelerate into a recession or a slower growth period. This is going to continue, the economy is going to continue in really strong shape until some kind of outside factor like a pandemic or something internally like a financial crisis occurs to stop it from growing as strongly as it has been growing. So here I'm gonna share my screen. I'll go back and forth so that it's not up the whole time. But I'll show you where the economy stands right now and where it has been the last few months. So let me get this up. Okay, now you should be seeing a, yeah, I think you are. Okay, so here's a slide of where the economy has been the last few quarters and where we anticipate it going for the next few. The economy grew really strongly in 2023. It grew well above where anyone thought it would be. We thought it would grow. We thought there'd be a recession last year. And there was no recession. There wasn't even a slowdown. The economy grew about 3%. Depends how you measure it, between 2.5% and 3% in 2023. At the end of 2023, in the fourth quarter, it grew at 3.4%. It's really an astonishing amount of growth. Going into 2024, you do see a slowdown, but it's still really strong. It's still really good to be growing over 2%. That's what we're tracking right now for the first quarter. The first quarter is over now, but data is still coming in. We'll get the number for the first quarter in a couple of weeks, but it should be between 2.5%. Again, really strong. Now, it might slow some more throughout the year, but it's still going to be growing really strongly above where most people thought we'd be in 2023 and in 2024. Because again, we've been waiting for this other shoe to drop that the economy just won't be able to continue growing at a strong clip. And it is growing at a strong clip. It's growing at such a strong clip and this is normally the case. The rest of the world would gladly trade places for us. We are the strongest growing economy in the developed world. And we are, as always, the envy of the world when it comes to economic growth. So we're in a really good standpoint, or it's a really good point right now. But of course, that leads to the question of how can this occur? How can this continue to be the case when we do still have high inflation? We've had really high inflation going back a couple of years. It's come down, but it's still above target. We have much higher interest rates than we've had in the past. So we have a lot of headwinds that we're dealing with. And the answer for the last, going back to COVID, so over 4 years now, is that consumers continue to spend at a really astonishing clip. So this is all spending. So it's goods and services, businesses, individuals, everyone. Spending, so you can look at the line that jumps around, but just look at the bars up month after month after month. It keeps getting bigger and bigger and bigger. And that means consumers are continuing to spend at a really, really high clip. Again, so it leads to another question of how could that be the case when we do have the big headwinds of inflation and higher interest rates? And the answer really comes down to one simple thing. So I should have said at the top that there's one thing that I think really helps square a lot of circles. It really helps us understand why we can have such pessimism about the economy on one hand, but really top line numbers being very, very strong on the other. When I say top line numbers, I mean things like GDP growth is strong, job creation is strong, wage growth is strong. The things that people care most about are really, really high. But how can they continue to keep spending? It comes back to one simple fact, which is that we do not have enough workers in the economy. We have a worker shortage. I can and will dig deep into that. But when it comes to consumer spending, they can continue to spend at this very high clip because if you want a job in the United States of America today, you can have one. And it pays pretty well. Wages are growing very strongly. They're growing above inflation, and they have been for a long time now. That wasn't the case in the aftermath of COVID and then higher inflation rates, but it is now. So if you wanted to, and here's the chart to show it. There are 2.3 million more job openings than there are unemployed workers to fill them. This data is as of yesterday. So businesses are really stretched when it comes to finding workers. They can't get enough. I give presentations like this frequently all around the country so different industries, different size businesses, all different regions. So all types of businesses that you can imagine. And I ask them all if they have enough workers presently, and no one says yes. They're all still searching for more workers. Okay, so if you have that job, if you want a job, you can get it, and it pays pretty well. The dark blue line is wage growth. It's been above inflation since middle of last year, so it's been paying pretty well, and you can get it. And if in that period when wages were falling behind inflation, consumers had two things to fall back on. They had savings. Every bar above that dotted line was savings in excess of the pre-COVID trend. They added up to almost $3 trillion in excess savings over the course of COVID. So consumers had a lot of extra money to spend, and that helped buttress spending in the aftermath and with COVID. By the way, I got a lot of pushback on this when it initially started to occur, and I started pointing it out. People would say, well, that's just really rich people who are saving. And yes, Elon Musk and Bill Gates and Warren Buffett, they saved a lot of money during COVID. But $3 trillion is such a gargantuan sum of money that it had to have been broadly distributed. And it was. Well, we got some data. It's hard to get data on savings accounts, but we did get some that showed that savings was broadly distributed. So consumers had savings, which they've largely spent down now. So that's not there to help keep spending up, which is probably the main reason why we see a decline in future forecasts for economic growth. Consumers continue to spend, keep the economy growing at a good clip, but they don't have the savings to help grow spend even higher and above pace and above trend. So savings has come down, probably largely gone for those who need it, as is credit card capacity. So during COVID, we as an economy paid our credit card debt down enormously. We've spent it back up really rapidly. So those who need their credit cards to help make ends meet probably have exhausted that resource. So that's not there to help, again, keep spending up above trend. The important thing to note about this is that a couple of things. Credit card debt is not a systemically risky thing right now. We're not that concerned about it because as a percentage of income, it's still well below the average over the last 20 years. So it's not a systemic problem. It's a problem for some of those who need to make ends meet. But when it comes to a systemic risk issue, it's not there yet. You will see and hear stories about defaults rising. And that is true. Defaults are rising for credit cards, autos, credit cards and autos. But that is for very subprime borrowers, people with poor credit risks. It's happening, and it's occurring from very, very low levels, historically low levels. So it's really not that much of a concern. The auto one is probably kind of the most interesting story, and that's because of certainly the credit worthiness of the borrower, but it also goes back to the huge spike in car prices we had during COVID. If you needed a car, you had to pay an exorbitant, outrageous price for it. Might have been beyond your capacity to pay for it when things normalized, and that will lead to higher delinquencies in the future. And I think that's what we're seeing at this point. So even if we had a downturn, you can see why. And again, I'm not predicting a recession or anything like that, but even if we had a downturn, I think it would be really muted because businesses are not going to let go of workers. They're going to hold on to them as long as they possibly can, and by all means, because they just went through a period where they couldn't get enough workers, where they were substantially understaffed during COVID and the aftermath. Now they're still understaffed, and they've learned that it's really hard to make their good, provide their service when they don't have enough workers. So they'll probably keep them on, even if the economy slows a little bit. Whereas in previous periods, they didn't do that because they could easily let go of people and then bring in a new worker later on. So I think that really this worker shortage really puts a floor under how far the economy can fall in the current time frame. So yeah, they're going to continue to hire. They're going to hoard their workers, and that will really that's beneficial for consumers, and that's good news. So, but again, I think spending continues strong. So I think 2024 is good. 2025 is probably better because inflation. We're going to talk a lot about inflation as we go forward. Probably decline more. And I think the economy gains steam as long as nothing else pops up. There's always the unknown unknowns. Real quick I want to mention about the worker shortage before we go forward. This situation where we have too few workers is going to remain for the rest of our lifetimes. Everyone on this call, all of us, we are now in a period where we will have too few workers across the economy. And it comes back to a demographic problem that was always on the horizon. COVID accelerated it, got it here faster than we thought it was going to get here. But it was always coming because we have a demographic inversion. The baby boomers were an enormous generation. Generation X coming after them was smaller. Usually generations get bigger, so you get an inverse pyramid. So every succeeding generation is bigger than the one before it. The Generation X was smaller than the baby boomers. Millennials are bigger than the baby boomers, but not by much, and not enough to make up for the smaller size of Generation X. And then I always get this wrong. Generation Y, whatever comes after millennials, is smaller than the millennial generation. So it has really big implications for workers. So what we have is an aging population. Older workers work less than younger workers. So we'll have the labor force will grow, but as a share of the population, it will shrink because, again, older people work less hours and work less than younger people. So that is a big implication. That's why we'll have the worker shortage for as long as we'll all be around. But it has big implications for things like the educational system. There are going to be fewer students coming through K through 12 and in secondary education. And so I talked to a lot of community colleges. You can imagine they're big parts of their communities where they exist, other educational institutions, and they know this. They see this coming, that there's going to be fewer and fewer students going through the system as they go forward. So it's a lot of interesting implications that come out of that, particularly when it comes to, and I'll talk about this at the end, that businesses are going to have to figure out ways to operate with fewer workers than they've become accustomed to. That's going to mean investment in things like AI, automation, mechanization, and we're seeing that in a really big way right now, which is one of the major stories in the economy right now, is that productivity growth is through the roof. That's really the thing that we as economists care the most about, because if productivity is rising, that means businesses are becoming more profitable. That means that they can pay much higher wages. We've seen wages are growing really strongly, over 4%. So how can they continue to do that? Well, it's because productivity. Their workers are earning those raises and more, which means that businesses can continue to pay those higher wages. This is really good news, but I think a lot of it comes back to the investment in the things I mentioned. We'll circle back to that near the end. Okay, so when I talk about this, though, I get there's a lot of people who just don't think the economy is doing really well. They need to be like me and accept. They don't have to love it, but they have to accept it that the economy is doing pretty well. But because of that, I did put together some data points that point to the economy not doing so well, because there always exist, but try to explain that there are reasons why people would feel this way. And again, the reason the big numbers to point to are the ones we care most about, basically our bottom lines. GDP is growing really fast, and I said this already, jobs are growing really fast, and wages are growing really fast, and productivity is through the roof. So those four major things that we really care about, really the headline numbers are really, really strong. Other things, though, there are data points out there that aren't so strong. One is manufacturing has been really, really sluggish. It just this last month moved out of recession territory when it comes to the way that we measure their optimism on manufacturers. So manufacturing has been down. I think that has a lot to do with coming out of COVID. They did really well during COVID, and coming out, there's been a reversion. Small businesses are really pessimistic about the economy. They're really down. I'd say they're the group that's the most pessimistic about the economy. They're at like 50-year lows when it comes to their optimism. Consumer confidence has been fairly real low. In fact, it's been really low. Consumers don't feel good about the economy. And there's a few other ones as well. But I think what it really comes down to, and the explanation for why businesses and families and consumers would say that they don't think the economy is doing really well, it is inflation. So we'll move into that now. But for when it comes to inflation for families, I think the thing that really hits hard, the reason why they think the economy isn't doing well and they're still really concerned about inflation, which is still high, is the way inflation's hitting right now. It's hitting the most for necessities: food, energy, and housing, particularly food. So I'll give you a couple examples that I like to give from my own life. So I've got 3 boys. We live here in Washington, D.C. So when my wife goes grocery shopping, she's shopping for 5 of us. Pre-COVID, and my kids are 10, 7, and 12, 10, and 7. When she goes grocery shopping, prior to COVID, the bill would be like $225, $250. Now it regularly runs close to $400 a week. So we're seeing that week after week after week. And so are families across the country. So of course, we're all going to say that inflation remains a big problem. And just going out to lunch on a daily basis, you can't get a sandwich and a bag of chips at Potbelly's for under $15 now. It's a real big shock to the system. And well, I'll get into this. Those prices aren't going down. That's not how inflation ends. So I think that there's a real good reason why consumers tell us the economy's not doing well. And their key problem prior to COVID, when you do focus grouping and talk to them and say, well, why don't you think the economy is doing great? Or what is your biggest concern about the economy? They'd always say that they couldn't get ahead. They couldn't save for their kids' education. They couldn't save for their own retirement. That's happening now. So they have a job. It's paying really well, but it's really just helping them tread water because they're having to pay the higher prices for necessities. There's nowhere to escape paying for food, energy, and housing. And so they're still not getting ahead. They're treading water, but they're not getting ahead. And I think that translates back to their confidence and their sentiment. On businesses, I think it's also a straightforward calculation is that those higher wages. Businesses have to pay higher wages to get workers in the door. They still need workers, so they have to pay. And what happens, particularly for smaller businesses, every time they hire a new worker, their entire wage bill is going up. So imagine that you hire a new worker today, and you have to pay them $20 an hour. Pay them $20 an hour, but maybe you hired somebody in December and you paid them $18 an hour. Well, you can't pay them 18 and the new guy 20. So you got to pay the guy you hired in December $21 an hour. But you can't pay the person that you hired pre-COVID in 2019 $22 an hour. Now you got to pay them 30. So their wage bill is kind of constantly getting pushed up and their margins are getting squeezed. I think the story is as simple as that, or straightforward as that. I'm open to a lot more interpretations, but we've done a lot of talking to businesses, and I think that's what it boils down to. Okay, so now on to the big elephant in the room, which is of course inflation. And I think we got to start by saying it's gotten better. There's no doubt about that. At one point, inflation was running 9% on an annual basis. It's now down closer to 3%. But, and this is key, 3%. There are very well-known economist, very famous one who has a Nobel Prize. I don't have a Nobel Prize, but he says that inflation is over. We got to get over it and move past it. Again, he has a Nobel Prize. I don't. But the Fed, their target is 2%. And the last time I checked, 3.2% is more than 2%. And it's 50% more than 50% more. So it's still a problem. And it's been stuck too. You can see from the chart, it's not like it's continued to go down. It's plateaued for several months now, going back to almost the middle of last year. So we're talking over 6 months now where inflation's been bumping around in a very narrow band around 3%. So it still remains a problem. Again, much better, getting better. And this is key to remember, prices are still rising. It's not that they're falling. Prices will not fall. We do, and this is what I was alluding to with the food prices. Inflation doesn't get better because prices decline. We're never going back to the price level we had pre-COVID. We will just have to adjust to a higher price level. The way inflation is solved is that prices stop rising at a higher rate. So they're still rise at 2%. They're just not rising at 3.2% or 9%. They're rising more slowly, and we adjust to the new higher price level. Some economists did crunch some numbers and said that usually it takes 2 to 3 years for consumers to adjust to that new higher price level, which makes sense. We all intuitively, we want a lower price level. We want to go back to what it was before, but that won't happen. And that's okay. We don't want price deflation. Deflation is as destructive as inflation. We want the price levels, the price rises to moderate, but that's not a satisfying answer. No one wants that. They want lower prices, but that will not happen. Okay, so price level has moderated. It's not growing as fast as it was. And it's coming down, but here's another key one to look at. So that one I just showed you is a broad measure of inflation. It's called the Consumer Price Index. It's the broadest measure we look at. It's the one that gets the headline numbers, but that's not the one that the Fed really focuses in on. They focus in on something called core, slightly different measure, core PCE. It's still well above 2%. I think it's about 2.8% now. So again, we still have a ways to go. Now, if you follow financial markets at all, you'll know that they've been pushing really, really hard for a rate cut now, like immediately. And earlier this year, I think it was probably the January meeting, the markets had convinced themselves that the Fed was going to cut rates in March. And Fed put out its communications and said, we're going to cut rates later this year, and all kind of the standard jargon that they put out. Inflation is still a problem, so we're still going to continue to fight it. And the market tanked hundreds of points in a day because, and afterwards, somebody asked the chair of the Federal Reserve, Chair Powell, if rates were going to be cut in March. And he said, I don't know where you got that. We never said that. The market had convinced itself that that's when rate cuts were coming. They had jumped the gun. These charts are to show you that inflation is better, but it's not quite there yet. So it's a long way of saying, I don't think the Fed cuts rates anytime soon. I take them at their word. I'm not one of these people who tries to reinterpret what they say. They are very plain in their language. They don't change it a whole lot. It's right there in black and white in the materials they put out every time they meet. They're going to keep rates steady for a while until inflation comes down more. And when it does come down more, they'll cut rates 1 or 2 times, maybe 3 times, and that would be later this year. The problem that they've run into at this point, though, is that they're now firmly in the election cycle. So there's a lot of pressure on them, usually from the Democratic side of the aisle, to cut rates. That would be good for President Biden. It would help the economy grow faster. So if they do that, they're going to be, if they do it prematurely, which is, or perceived to be prematurely, it's going to be looked as though they are not, they are putting their thumb on the scale in favor of President Biden. On the flip side of that coin is that they wait, they're going to be seen as putting their thumb on the scale in favor of former President Trump. So they're in a bit of a bind when it comes to what they do with rates and when they cut. But I take them at their word that they will be data dependent, and when the inflation data warrants it, they will go ahead and cut rates. I just again take them at their word that it will be later this year, and it might be after the November election. And keep in mind, so the Fed has done a lot, so they're not going to raise rates. That's definitely not going to happen. They've done an awful lot when it comes to raising rates, so that we're not going to raise rates, but there's an awful lot of tightening that will happen for them. They don't have to do a whole lot. If you follow Treasury markets at all, those rates were going up for a long time. That was doing the work for them. But the two big things that really still continue to tighten financial conditions are, one, business loans are generally 5 years. So if you are now having to refinance a loan, you totally took it in 2019 when rates were pretty low. And for another year, we're still going to be a couple of years. You're going to have businesses that are refinancing loans that were taken out when interest rates were at record lows. They're going to go from, say, a loan that was maybe 4% to now one that's over 8%. That will do a lot of tightening for the Fed without them having to do any additional rate increases. And they still, if you know anything about the Fed, they have a very large balance sheet. They own a lot of treasuries and mortgage-backed securities. They're selling that off as well. So they are doing stuff to continue to drive inflation down. Some of it's on autopilot. Some of it is their actions. And you can see the result of this. This is the money supply. The big hump is during COVID. So that's all that money that the Fed pushed out. Prices rose in the aftermath. Inflation came. There were three causes. One was supply constraints. We had the big problems with supply chain during COVID. The second was all the money being pumped out from Congress, all the multiple rounds of checks and all the income support that occurred. And then, of course, the Fed's increasing the money supply. As they've shrunk the money supply, it's come way down. It's now below trend, below where it would have been on its pre-COVID trend. And that's why you'll continue to see the price level fall. It's interesting to point out, though, you see how smooth that line was for a very long time? You could take that line back to 1982, and it would be just as smooth. It's a period known as the Great Moderation, when monetary policy got very, very good. And we had a period from 1982 until March of 2021, when we had very low inflation on average. And it was marked by the money supply growing at about the same rate as the economy. And it had very good effects. We got away from that during COVID. It's not a way to criticize the Fed. They had to stop a financial crisis and ensuing economic crisis on the heels of a pandemic. They did everything right and they did what they needed to, but this was kind of the inevitable result, especially when you had those supply chain issues and the huge amount of spendable money that was sent out from the federal government. Okay, excuse me. Oh, last thing I'll say about inflation is that I think it comes down. I think we get closer to 2% by this year. But if you look at the Fed's own materials, they show the inflation rate getting back to 2% in 2026. So still 2 more years until we get all the way back down to 2%. So we have a ways to go before inflation is finally well behind us. So with that, let me touch on a few rates, and we'll get into this in Q&A, and James has some questions teed up on this as well. But all the things I've talked about have a lot of assumptions baked in, but a lot of things that we can't bake in. So geopolitical risks, Russia, Ukraine intensifying, Israel and Gaza intensifying, and both of them either or spilling over. China invading Taiwan, geopolitical or an unknown. Geopolitical risks are something we always have to be aware of. We have domestic political risk. This current Congress, believe it or not, still has 3 must-pass pieces of legislation to do this year in 2024. Has to pass a budget for fiscal year 2024, which started in October of 2023. Still hasn't done that. Has to pass a budget for next fiscal year, because this fiscal year ends on September 30th. And they have to pass a debt limit increase. The debt limit expires, we hit the cap, no matter how you want to say it, January 1st, which is in this Congress. They have to raise the debt limit as well. And we have an impending debt crisis. We're accumulating way too much debt. Those are major. So if they don't pass budgets and they don't raise the debt limit, it's going to have an impact on the economy. The other risk that is kind of out there, it's been kind of kicking around for a little bit, but hasn't really hasn't risen to the level of that I think a lot of us feared, was office space. Remember, I talked about how interest rates, businesses are turning them over. That really impacts office space because the value of office space has declined markedly in the aftermath of COVID. So imagine, let's just say the big cities. It really matters for urban centers, and the reason why is that Return to Work. So Castle, the office security place, office security company puts out a index of return to work, and it's just for some 10 major cities, but even cities that you would anticipate being the most back, so Houston, Dallas, it's still about 60%. So you're looking at like 50% occupancy in some places. DC was under 50 for a long time, and so these high, tall office space complexes are now facing two pressures. One is they're 50% occupied, so their value going to decline a whole lot, and then the interest rates. They might have been built or financed with a 4.5% interest rate, and now it's 8.5%. So the value of those buildings is cut in half. So you might have had a $500 million building pre-COVID, or even a few years ago, and now it's worth $250 million. And a lot of the owners of those buildings can't make those economics and those finances work, so they're handing the keys in to their lenders. This is really for buildings that are not modern, that don't have the modern amenities that employers and employees demand and would like, and that aren't in the most desirable location. So outside the hottest spots in New York City or San Francisco, or any of the major cities. So this could be a big strain. And it turns out that the Wall Street Journal has done a really good job covering this. It turns out that it's regional banks, the same banks that got nailed in the aftermath of SVB. They're the big lenders for these type of office spaces. Would have thought it would be the biggest banks, but it's the regional banks that do a lot of the lending. Whether they own the loan outright or they syndicate them, they have a lot of exposure to these buildings. So something to watch. I don't think it's a systemic problem. We've been told since 2010 in the passage of the Dodd-Frank Act that banks are well capitalized and can handle losses. So again, I take the regulators at their word that they can do that, but banks might have to absorb some of those losses if the owners of the building start turning the keys in and defaulting. I'm gonna stop. I'll stop there, James. I have a lot of other things I can talk on, but I think they'll come up in Q&A. I thank you for your attention, and I'll hand it back to James for now.
Curtis, thank you so much. That was fascinating. Let's move on to the broad economic insights that we're going to talk about today. And you talked about where you anticipate Fed rate cuts coming and when that might happen. Do you foresee any scenario where the Fed doesn't cut rates or takes much longer for that to happen? And what would need to happen for that to be the case? Because as you said, it seems like we're getting close to rate cuts.
Yeah, it's a good question. And yeah, I do. And I think if you follow, I have CNBC on usually throughout the day, and I usually only pay attention when somebody from the Fed is on. And if you pay close attention to what they say, there is a scenario that happens, and that is if inflation doesn't come down, if it remains stubbornly high. That could mean it rises again. It could also mean that it just sticks where it is. So if it just stays at 3% by the end of the year, they're not going to cut. They won't be able to. They don't have the ability. So much of what the Fed does, their ability, their effectiveness comes back to their credibility. And if they cut rates before inflation comes down to a satisfactory level, then they lose their credibility and they really lose their power. So they're going to have to absolutely wait to cut rates until it's very clear that inflation is on a glide path to 2%. So that doesn't occur. And again, I showed you the chart. Inflation's been caught in that range for several months now. That remains the case, and it certainly could. Inflation is a very tricky thing to get under control once it gets out. That they might have to delay rate cuts until 2025 or beyond, or 2025. I think at that point, I mean, they've been pretty clear they want to cut rates. Not to get too political about it, but a lot of the board is now appointed by President Biden. They're much more dovish when it comes to monetary policy. They want to cut rates. So they would put a lot of pressure on. So it's the chair who really dictates, but they can put a lot of pressure on. They want to see lower rates, and I think at least by this time next year they would have a stronger case for it. But it could be, again, the data they put out shows rate cuts later by the end of this year, but there is absolutely a scenario where it gets delayed to 2025.
Okay, wow. All right, so you touched on this briefly. We're in a time of intense geopolitical conflict on a number of fronts. What are some of the potential economic implications for the U.S. economy, going forward from the conflicts that we have now and then these unknowns that are out there as well?
So I think there's three things to keep in mind. One is that for the most part, any economic impact from Russia, Ukraine, Israel, Gaza is probably already in the system and probably already incorporated. What we can't anticipate is the smaller, like the Houthis blocking the shipping lanes in the Red Sea. Those are very disruptive, and we can see remember the Suez Canal got blocked for a couple of weeks. We're going to see here in Baltimore with having a fairly major port shut down for a while. These things matter, and when ships have to get diverted and go much further courses, it increases prices and it disrupts global commerce. So those are things that we can't anticipate and seem to be happening with more frequency. But the big risk, and I mentioned it briefly, is if China ever did anything that forced us to decouple from their economy in the same way we did with Russia in the aftermath of their invasion of Ukraine. I think what you'd see is a lot of countries led by the US running the same playbook, which is cutting off economically. Now, this would be really bad for the U.S. economy because we're much more integrated with the Chinese economy than we are the Russian economy, but really bad for China as well. So I think it does factor into China's calculations, knowing that would be run against them and that they would suffer substantially economically because of our actions. Remember, so Russia was largely saved by China and India continuing to engage with them, but China is the big actor, the big economy. They don't have somebody that they can then lean on to help prop them up.
Great. All right, so moving on to domestic policy. It's been a few years since their passage, but I want to talk about the Inflation Reduction Act, the CHIPS Act, and the bipartisan infrastructure law. Talk about the effect that those pieces of legislation have had on the economy. Just recently in the short term, are they having the impact that we thought they were going to have? And what do you expect to see long term coming out of those pieces of legislation?
Yeah, so I think you have to look at them all together. So it's the CHIPS Act, which is subsidizing the manufacturing of chips here in the US, superconductors and microchips. The infrastructure bill, which was a lot of had some of that as well, but it had a lot to do with keeping funding for infrastructure spending in the U.S. And then increasing the levels. And then the Inflation Reduction Act, which was a lot of subsidization for the production of green energy, but the manufacture of green energy products. So you look at them in total, I think a lot of it was inevitable coming out of COVID that we were going to try to incentivize the manufacturing of important things here in the U.S. And those three things together kind of get there. I think it's probably over. I don't think that push will continue. When you ask whether it was successful, the answer is it depends how you look at it. Was it success? If you pay people and businesses to do things, and all the different subsidies and all the provisions in those are very, very generous, yeah, it's successful. We're building electric battery plants here. We're building chips factories here. We're building solar panel factories here. We're building windmills here. We're building the manufacturing capacity to do so because the subsidies are so lucrative. So yes, it's been successful from that standpoint. Whether it's successful in growing the economy, I would say no, because what the White House will point to, and it shows up very clearly in the manufacturing data, or I'm sorry, the construction data, is that there's a huge amount of spending going on in manufacturing. But again, if you pay people to do it, they're going to do it. But that money would have gone elsewhere. And that's really what you have to account for the unaccountable. Where would that investment money have been spent had it not been diverted to a new chips factory or a new solar panel factory? So at best, it's a one-for-one trade-off, and it could be a negative trade-off if it's going to a less valued use.
Okay. All right, moving on to industry-specific insights. What are you seeing in the auto market right now? We've heard some news about the EV market running into headwinds, so I want to get your sense of that and what that might mean for the industry.
Yeah, so prices went way up during COVID, and those who, I touched on this before, you really needed a car, you were have to pay exorbitant prices for new car and then used cars. Some of that pressure has come down. I think that auto manufacturers have gotten back to a more normal cadence and are getting, although there are still disruptions every now and then, but getting new models off the assembly line and getting them to consumers. The big trend that I've noticed recently, though, is that prices are high, and I just think that this is going to be something that wears on consumers, whether it's an electric vehicle or a old internal combustion engine. Prices are really high. The example I use is, so my in-laws, they live in Michigan. They're Ford execs, retired Ford execs, and my mother-in-law got a new car last summer, and she's driving us around rural Michigan, and it's a Ford Focus, not Ford, anyway, it's a Ford sedan, and she's showing us all these bells and whistles, like this camera that watches her, and if she takes her eyes off the road, the car will stop on its own. And I said, what if I just want a car? And I really just want a car. I live in Washington, D.C., and I work in Washington, D.C. The Chamber of Commerce is on Connecticut Avenue, right across the street from the White House. I live at the other end of Connecticut Avenue, but it is like demolition derby driving down here during the day. So I got the first day I got one of her old cars, actually. The first day I had it, somebody hit me out in front of my son's school. And I was just like, I gotta get to work. Have a good day. I want an old car because I have to deal with that every day. You cannot get a normal car anymore. The average price is exorbitant. And I think consumers are going to eventually rebel against that. That no, I don't want the camera that's watching me all the time. I don't want all the bells and whistles. I just want a car to get from A to B and cost a reasonable amount. And I don't have to finance in a really big way. And I think that the pressures with higher interest rates and just the higher prices in general will lead to kind of a pushback on being forced to pay for the higher margin, the higher priced vehicles. I think that also plays in with electric vehicles. I assume that the auto manufacturers want to move to electric. They're getting a huge amount of pressure from the current administration to do away with the internal combustion engine and move to electric. But consumers are not quite there yet. But again, if they're more expensive, that's why the manufacturers will want to go there, because it's a higher margin price. Same thing happened with the light bulbs going to LED lights. But when it comes to cars, I mean, it's going to come back to basic market forces, which is, are they willing to pay exorbitant prices, or where are the most consumers? Are they willing to pay the higher prices? Are they like me? They just want a car that if they get hit, they can just let it go and move on with their day.
Right. Okay. So we heard you talk a lot about the commercial real estate sector. Want to touch briefly on the residential real estate market. So we've got high interest rates, we've got low inventory. It's really putting a squeeze on folks, especially first-time home buyers. Do you see any relief on the horizon at all? Are we going to need to wait for rate cuts, or what are you seeing there?
Really good question. Hopefully you can see the mortgage rate chart.
Yes.
I got really, really bad news for you if you're in the housing market. Prices aren't coming down. So their mortgage rates have gone up. These have already incorporated in all the rate increases, and then the rate cuts coming in. That's where they're going to stay for this foreseeable future, between 6.5% and 7%, average 30-year fixed rate mortgage. But this is the more unsettling one, which is that home prices are rising again. So they came down sharply in the aftermath of interest rates going up. Now they're rising again. And this all comes back to supply and demand, as everything does in economics. We have an imbalance. We have way more demand than we have supply. So we have a lot of demand because I talked about the millennial generation. They're aging into the home buying age. They want to buy homes. They're having families. So demand is up, but supply is badly constrained. It's constrained for two reasons. One is that we have just not built enough units. And this is, again, for every market around the country, it's 2-3 million units short across the country. We have not built enough in the aftermath of the financial and housing crisis in 2008. So now we're at year 16 of not building enough. And you can see it very clearly in the data. Building tails off and it has not caught back up. So we're not building enough units, and that has a lot to do with, sure, the aftermath of the housing crisis, but it also has to do with really cumbersome permitting and permitting rules and zoning laws. Makes it really hard to build new units and very costly. And then the other thing is there's been a change in the preference for existing homeowners. This is partly driven by higher interest rates recently, but it predated that before. This has been going on for a while. People are staying in their homes much longer than they used to. There was a reticency to sell homes where there wasn't before. So if you look back in the data, usually there's 6 months of supply on the market. Now there's regularly 3 months of supply. So people are just not selling their houses at the same rate they used to, and that has led to large shortages. And that will mean, so if you're an existing homeowner, it's great because prices are going to continue to rise. If you are a new home buyer, you're going to be facing higher prices and higher interest rates for the foreseeable future.
Wow. Okay. All right. Moving on. So you touched a little bit about generative AI. We've got a lot of questions on this, and I know we talked about this a little before this webinar. It's on the top of mind for folks in virtually every sector of the economy. And you mentioned automation, mechanization. What impacts are you seeing from AI now in the economy? Where do you see us in the next 1 to 2 years? Is it replacing jobs? Is it just helping businesses get more efficient? And they're going to keep folks on, as you kind of mentioned before. How does that look with AI?
Yeah, I think that it is all those things. And AI, at least right now, to me, is like any other technology that's come along since the beginning of the Industrial Revolution. And what it means is it's going to make workers more productive. It makes us more efficient and more productive. It means that we'll all make a lot more in the long run. There'll be disruptions in the interim that will certainly occur. But we've seen that the American workforce is incredibly adaptive in the aftermath of COVID. I think one of the reasons why wage growth has remained so strong is that a lot of people moved from jobs they didn't like necessarily, or that weren't all that remunerative. So service type jobs, retail, leisure and accommodation. They took the time during COVID to upskill, and now they're in more higher paid, better jobs that require more skills that they were able to acquire during COVID. Same thing with AI. It frees people to do jobs that have more value add that machines and computers cannot do. So it will make us all more productive. I think that's part of what's going on with the productivity data, that workers are a lot more productive when you can have AI working off to the side. And by the way, I have not tried to incorporate it yet. I really need to. Working off to the side, drafting memos, drafting emails, doing kind of the type of stuff that AI is good at, or assistants used to do, things like that. I think that it's really boosted the productivity of a lot of workers around the economy, which is feeding back into their pay because they're able to do the more highly valued tasks, which means their employers can continue to pay them more. So AI is one part of it. Automation, just using software, mechanisms, all these things that we're seeing. So the one that we have the most interaction with is the ordering kiosks at fast food restaurants. But
right.
Really a really good example is an Amazon warehouse that they're moving, or it's not even just Amazon. All companies use these they're not warehouses, not the right word. I call them distribution centers, but they're really kind of modern marvels of technology. Like robots and mechanization does a lot of that work now, when it used to take a lot more people going from aisle to aisle picking things and forklift operators and all that. A lot of that is done mechanically now, and we're going to continue to see that as we go forward. We could see it. I don't know that this is all that imminent. The self-driving cars, and that would mean a lot of truck drivers are put out of work. But if it's more efficient and less costly, that would be a good step. So there are a lot of different ways, but I think this is evolving. It's evolving faster, and it feeds into a lot of the reasons why we see such good economic data.
Okay. All right, let's go to audience Q&A now. We're getting a lot of questions about the public debt reaching 35 trillion recently. Is that sustainable? How much higher do you think this can go? I see you smiling, so I'm guessing you've gotten this question quite often, I'm sure.
No, it's not sustainable, but it hasn't been sustainable for a lot of years now. I used to work at the Heritage Foundation, and part of my job was to go around the country and talk about how debt was on an unsustainable trajectory and we had to get it down. And here's our plan for doing that. And that was 2008 to 2016. No one cared. And it's only gotten worse since then. They cared for a couple of years around 2010. Remember, we had the Tea Party wave. No one cared. That means politicians didn't care. There was a brief period. Again, I said 2010, but then in 2016, and by the way, I hate to get too partisan on this stuff, but there's only one party that ever cared about or indicate they cared about spending. Democrats, not their thing. They're not going to cut spending. It's not on their radar. It was on Republicans' radar, but in 2016, they had 19 options to choose for president. One of them didn't care about the spending and debt and deficits at all, and he won. So we've gone in one direction. We've gone in the opposite direction. So Republicans don't care now either. Yeah, no one cares. They're not going to do anything. There will be absolutely nothing done on debt and deficits between now and January of 2029. So you have two major party candidates who don't care. It's not part of their agenda. It's not something they're going to talk about or touch. And if the president doesn't care, Congress will not take it on. So we will continue to accumulate debt at an unsustainable level. And that's just the way it's going to be. I don't know what the end result of that all is. Whether that, and at the end of the day, people around the world will continue to lend to us because we're the United States of America. Yeah, it's a lot of debt, but I'm not advocating this as a solution. We have the taxing capacity to pay it off if we want. It would be painful, it would be awful, it would hurt the economy, but we have the income to back it up. So maybe the impact doesn't come for a long time, but the bill will eventually come due. And I think it's going to really pick up in the next couple of years because the interest as a share of the budget will continue to eat up a bigger part of the budget because interest rates are rising. So you add that to rising spending on Social Security because the aging of the population, same with Medicare, and there's going to be a real squeeze on the discretionary parts of the budget, which members of Congress really love to increase because it gives them ribbon cuttings and things to point to when it comes to re-election time. So there will be a lot of talk over the next 4 years, but just really no action because there's just no appetite for it at the top of either party.
Okay. All right. Another question coming in. So how concerned are you that economic growth has been concentrated in tech and this, magnificent seven rather than spread broadly across other industries? Is that something you're concerned about, or is that not so much a concern?
I think that's kind of largely how it goes, that there are industries that lead the charge when it comes to growth. So it doesn't concern me too much. And then, you kind of see, what you want to see is that you have new businesses cropping up. If they're in one industry, that might be interesting, but just look at where we're going now. We're going away from necessarily I forget the number, but so Amazon, Microsoft, Google, Facebook, those were the group and a few others that were leading the growth. Now we're switching over to AI, and we see new companies emerging in that industry and in that field, and we see an incumbent and existing business like Google really struggling with AI and trying to keep up with the new entrants. So it doesn't bother me because I think the economy still remains dynamic. And that won't remain the case forever. Those companies will be surpassed. Microsoft's a really good example of evolving, though. They've been a very good company to evolve from operating software to what they are today. Those companies will evolve and be very good companies, but the growth will be led by a new wave that might be more efficient with AI or whatever comes after that.
Okay. All right. Well, it's hard to believe we're almost at the top of the hour. We're going to have one last question for you today, Curtis. Just what are some economic indicators that we haven't discussed today that you plan to keep a close eye on? Is there anything else out there that you're you're keeping a watchful eye on as we go into 2024 or 2025 rather?
I'm looking through. That's a good question. I'm gonna, and it's two things that I'll point to that I didn't talk about. One is we didn't talk about energy prices. We didn't talk about oil. Really hard to gauge. Oil prices remain high compared to where they were, say, a couple of years ago. They'll continue to fluctuate. But I don't have a good read on where they'll go in the next 6 months or anything. But the other big one is the U.S. dollar as the reserve currency. I get this question all the time, which is that will we be surpassed? Will there be a new reserve currency for the global economy? And my answer is not in our lifetimes. Absolutely not. The U.S. dollar will remain the reserve currency for a lot of reasons, and the biggest ones being we're the biggest economy, we're the strongest economy. In addition to that, all evidence to the contrary, we have the most stable political system, but more importantly, we have the deepest, most robust, most liquid financial system backed up by a very strong legal system. There's just no other country or group of countries that can offer all those things to lenders around the world, to people who just want to retain a store of value, excuse me, in their savings. So they're going to continue to come here to say it wouldn't be a dollar, but their currency, if I exchange into a dollar, I put $1 in there. I'm not even worried about return. Will I get $1 back when I want to get it out? And if somebody says it's not mine, can I get a fair shake in the legal system? There's nowhere else to go for that. And same thing goes for a flight to safety. So when things go badly around the world, where do you put your money? You bring it to the United States. So we will remain the reserve currency at the very least for the rest of our lifetimes.
Great. Well, thank you, Curtis. This has been an incredible discussion. We hit on so many of the high points on this topic, and just really appreciate you coming on the webinar today.
Happy to do it anytime.
All right, and thank you to everyone in the offices and at home for joining us. We so appreciate you tuning in. There's a link to our survey about today's program in the chat. Please let us know what you thought about this session. And if you haven't heard, we've got a podcast, the Travelers Institute Risk and Resilience Podcast. It's available now on Apple, Spotify, and Google. So subscribe to today. We've got the link in the chat. I hope you'll join us for our other upcoming programs. We've got an exciting lineup of both live events and webinars in the next couple of weeks. The Travelers Institute Cybersecurity Education Series is back on the road for our winter-spring 2024 tour. On April 30th, we'll be in San Antonio, Texas for a lunch and symposium. So if you're in the area, you want to join us, click on the link in the chat and check out our cybersecurity website. There'll be links in there to sign up for San Antonio and for other events. And then we've also got a great lineup of webinars coming up as well. On April 8th, we'll have a special Monday edition of Wednesdays with Woodward live from the Lifesavers Conference on roadway safety. We'll explore how technology can help assess crash rates caused by distraction, improve data collection, and promote safer driving habits. Then on April 24th, we'll sit down with leadership expert Chris Rollins to talk about inclusive leadership and how leading with vulnerability and empathy can transform the workplace. As always, visit us at travelersinstitute.org for registration, replays, and more. And if you haven't already, connect with Joan Woodward on LinkedIn for highlights about our web and in-person programming. Thank you again to Curtis, to the U.S. Chamber of Commerce, and to everyone online for joining us today. For Wednesdays with Woodward, I'm James Wolfe signing off. Thanks, everyone.